Welcome to The Real Money Show, the number 18778 Silver, the website, guildhallwealth.com. My name is Jeremy Wiseman. I'm joined here by Jerry Correia. And what a week in the precious metals market. Lots of conversations with clients, with people in the biz, lots of great videos that have come out. And one of the things that keeps coming up time and time again in my conversations, Jerry, over the last week, is there's a sense for people who are not committed to studying the markets, aren't sure if this is a top. They've seen a really big move in the market, and it feels like, well, that should be it. That should be the end of it. Yet when you look at what's going on, for instance, China added an estimated 15 tons of gold to its foreign exchange reserves back in September. Central banks buying at all-time highs. I saw Turkey, who their dollar is absolutely tanking. Their central bank is buying gold. I saw another one about India. Imports for silver are up like absolute crazy. And now you're starting to see other countries who are trying to stop exports on physical gold as well. But you know what the biggest one is? We're just jumping right into it. I hope you don't mind.
Let's go.
When you think about the 70s, where gold goes from $35 and lands at $350. Forget the $850 top. It goes from $35 to $350, right? From regular price to bottom of the market where it landed. That's 10 times.
That's a cycle.
Gold is up barely 2 times here. I mean, we kind of started at 2000. I think the low was 18. I don't know what price they say it started at. Do you say it's the low at 1,300, or do you say it started around 18? But to go from 18 to 4,000, that's 1 time.
Mm-hmm.
That's a long way away from 10 times. But is that the only criteria we should be looking at?
Not when you have the new fundamentals are at play with silver and gold. We're seeing an emerging between gold becoming more used industrially, and you have silver being used monetarily. You have to look at cycles, Jeremy. This is why we use our cycles. We use ratios to know how the silver markets and gold markets have moved for hundreds, if not thousands of years. We use the super cycles, for instance. We've had 2 super cycles in precious metals. The first one from 1970 to 1980, that was a stagflationary cycle, as we all remember, just coming off the gold standard from 1971. And then we had another cycle, another 10-year cycle from 2000 to 2010. And what did those markets do? What did the gold and silver market do during this time? Both gold and silver multiplied. Gold was up 1,400% between the 2 cycles on average, and silver multiplied 22 times. And we are right now in the middle, or if not the tail end, of the 3rd super cycle in precious metals. The 3rd cycle, actually, this is coming from Jim Rickards, and it was actually confirmed by Crescat Capital with Tavi Costa, sharing this chart. It's a 50-year macro chart, and we are actually in the 3rd cycle that began in 2016 when gold was at a low of $1,050 per ounce. And if we apply the 1,500% average between for the first 2 cycles at that gold low of 1,050 in 2016, you end up at 14,700 per ounce by next year. So by somewhere around 2026 to 2027, we have a major bull run ahead of us. Gold and silver have not even broken out yet, according to the silver to gold ratio, which we use as well. The precious metals markets are up quite nicely right now. We are enjoying the gains. We love the excitement. We're also coupling in with the fundamentals, the new fundamentals of silver usages, more than ever before. And now we have confirmation of further supply deficits, mining deficits coming out of the ground. There's not enough. There's not enough silver. And this is the new space race we're talking about. This is the new minerals war. The new currency war is the precious metals war. China is now halting their exports of silver. India is just amassing the most amount of silver, world record pace, over 500% increase of silver imports. And Canada is just sitting on the mines here, as Canadians are watching, and they're realizing now, Jeremy, that the government, the monetary policy, the fiscal policy is just spending on woke ideology policies, taxing us over and above the income tax. We're paying taxes left, right, and center, but we can't get ahead. This is the one way to get ahead. If you can land yourself at least 2,000 ounces, the end of that first cycle, all you needed was 2,000 ounces to buy an average home in Toronto, which is what, 1.5 million? You would need silver to go up to about $490 US per ounce, and that's where we're headed.
The number 18778 silver, the website guildhallwealth.com. On ITM Trading, Daniela Cambone was interviewing billionaire Pierre Lassonde. He thinks gold can go to 17,250. Those type of numbers, while they sound extreme, are not far off in terms of thinking about, if the Canadian government could print $300 billion out of nowhere, and this year's budget is $150 billion, when the normal budget's like 10 to 15 billion, that's 10 times, and you're doing that out of thin air, gold's got a lot of catching up to do.
Absolutely.
And our premise is that the gold price has been managed. Just like in 1971 when it was at $35 an ounce, the world knew that $35 an ounce was BS. They knew that that price was not real, and they were saying, give me the gold. That's what's happening in London. That's what's happening with silver and gold at the LBMA. They're saying, give me the product. I don't believe the price at $2,000 an ounce. I don't believe it. It needs to be way higher than that. I want the gold now. And so there's a lot of pressure in the markets, period, because you think about, you mentioned last week, the debts are close to 400 trillion around the world. The debts aren't necessarily going to be paid off unless you can create real GDP growth, unless you can create wealth. And the only way we do that here in Canada is dig, baby, dig,
right,
and drill, baby, drill,
stuff, right,
and actually build stuff and create things and dig holes. And if you're just going to leave it all there and tax people, you're not creating wealth. And that's the other thing. I think, one of the things that I feel is missing from the understanding of where gold and silver could go. And we're not just trying to be Pollyanna-ish. These are real numbers that people come up with when they look at the ratios and they look at where the debts are and they look at how much the assets need to grow on the balance sheet, is that we're so used to being psyop to think less.
Mm-hmm. Yes.
And get used to having less. And as
accept it, right.
That we should sacrifice more, right? That we don't think about what we should be, what we should have, how rich a country we could be, But beyond the borders of Canada, the world is buying gold. Indonesia is blocking it from leaving the country. China's looking for ways to block it. They just found out that they've been importing way more than they've been suggesting.
We talked about that in the show, right?
So there's just a lot of news going on in the market. We're going to talk about it throughout the show. But do you sense that from people? They just don't believe gold can go higher because they just don't believe in the success.
Absolutely. We've been psyoped for a very long time. A lot of psychological warfare happening. Don't own the stuff. Being dissuaded of owning physical precious metals has been going on for a very long time. But price is one thing. We've seen price action. If we can remember, the oil prices a few years ago actually went negative. Where are we getting prices from? The prices are coming from New York and London, two cities that really don't have much precious metals in terms of, tonnage versus India and China. These are rivaling exchanges now, where we have the Shanghai Gold Exchange, the whole entire golden corridor, and you have the Silver India Bullion Exchange. The prices are fictitious. When you have a price actually higher in Asia, which is the case, we have to question where are we getting their prices. So we cannot be fixated on price. We have to look at the value of what these critical minerals offer, high quality liquid assets, and it is about boosting the reserves to boost the balance sheets, because the debts are at this moment in time have exceeded to a crucial point.
Certainly the debts have not been taken care of yet. Adding assets to the balance sheet and increasing those assets to the balance sheet, I think, is a big part of why central banks are buying gold, as well as being able to protect against any volatility that might cause. For instance, the yen carry trade and what's going on in Japan right now. So having gold is a great way to protect, buoy your investments, protect against debt, protect against the counterparty risk that could happen with debt, but also to take advantage of the overall reset of what it's going to look like when all those central bank balance sheets go multiples higher. And that's where we believe this is going. So to us, holding physical gold and silver is an opportunity of a generation, and it's just starting to happen. So we're very excited that it's finally happening in the markets. And this isn't a time to say, oh, it's over. No, we believe we're just at the beginning. We're going to tell you why more coming up on the Real Money Show. If you want to get involved in physical gold and silver, give us a call. The number 1-877-8-SILVER. The website, guildhallwealth.com. We'll show you how to hold it in your registered account, fully allocated, segregated. You own it, no counterparty risk, held in a vault outside the banking system. This is your wealth. If you can't hold it, you don't own it. We prove that at Guildhall Wealth. One of the themes we're sort of just talking about this week is this idea that gold and silver have gone on a very good run recently. But to some people, they feel like, well, that's a good run. Let's call it a day, not looking further under the headlines, under the hood to see, well, why is gold rising and where could it go from here? We don't look at price. We look at ratios. We look at value. Price is what you pay, but value is what you get. And when you think about the debts out there, as we mentioned in the last segment, or the fact that central banks continue to buy it at all-time highs, that should tell you everything you need to know. When it comes to silver, again, we call it the new space race. It's the rare earth race. It's the race for building up manufacturing again, creating those goods that made people rich, that made them buy into the stock market and invest. If you don't have a company and you're not building things, what are you going to invest in? So nuclear, last week we talked about, you need over 5 million ounces of silver to build a nuclear plant, and there's scores, hundreds of these being planned on being built, let alone maintained. So as well, you look across the YouTube verse and the Rumble verse, and you see all of the analysts in the market who are calling for much, much higher prices, let alone the banks, which are conservative, calling for $6,000 or $8,000 over the next several years. By the way, you add 15% to gold over the next 5 years, you're already well into the 8,000s. You're not even really pumping up the price. You're just looking at average gains in the gold market. Which leads us to this, Jerry. A friend of mine sent me a link to an article from the 16th from The Economist. And the headline was, "Beware the scorching gold rally. Only one explanation for the surge makes sense. It will not reassure investors." Now, I have to tell you, as someone who's been doing this a very long time, I know a beware article when I see one, a cautionary tale, if you will. And this article does a terrible job of being cautionary. A terrible job.
They said one reason why.
Let's go through it, and you give me your comments. I'll give some color commentary. Let's go.
Let's go.
The jargon of gold trading echoes that of poker. Strong hands are investors loyal to the metal no matter what the price. Weak hands are flaky punters who fold at the first sign of trouble. Bullish investors win when they convince others their story for why the price is rising, which boils down to why this time strong hands outnumber weak ones. Their bluff is called when the market softens. If the price does not rebound, their story collapses. If it does, it gains credence. Okay, right there, first of all, this is not MicroStrategies. You can't talk up a book in gold, okay? That's what that paragraph to me says. It says, The bulls win if they can talk their book big enough. I'm sorry, guys. This is way too big a market to try to talk your book.
Like we need a mascot to promote gold and silver when the entire global economy and countries are accumulating over 1,000 tons of gold per year, regardless of price. I don't need a celebrity to tell me what to do regarding how to, strategize and tactically move my money into a safe haven, number one, and prepare for what's coming.
Yeah, this is like we're going to manage it higher by talking the book, and if we're successful, but if it goes down and it doesn't go back up, then you were not a real bull. Okay. This year, the bulls are winning so comfortably that the argument would seem to be over. After the gold price hit $43.80 an ounce, a record on October 20th, it fell by 10%, only to recover some of its losses. It's now 55% higher than in January and 47% past its previous inflation-adjusted peak from 1980. Many analysts predict it will break 5,000 by the end of 2026. Then again, earlier this year, none had anticipated it would cross 4,000 in 2025. Do theories explaining its soaring price make sense? Let's go. Each rests on a different buyer: institutional investors, central banks, and speculators. Begin with institutions. Gold's main attraction is a store of value, especially in times of crisis. It is tangible, easy to transport, and comes standard-sized bars tradable on a global market, which reassures investors with big portfolios. Gold's previous bull runs occurred after the dot-com crash, the financial crisis, and during the COVID pandemic. This time, however, it's a different dynamic at play. The gold price has roughly doubled since March 2024, despite a lack of recession. America's S&P 500 has risen more than 30% over that period. Real interest rates remain high. Perhaps institutional investors are seeking refuge in gold since they fear a crisis is near. Let's just stop there. Okay, so it's basically saying nobody's buying gold this time because of any of the problems that they've bought it in the past, which is actually true. Central banks aren't buying it because they're worried about the crash. They're buying it because it's going to revalue, and they want those gains on their books. And we know that for anyone listening to our show because central bankers have talked about it.
Yes.
There was a paper written on it by the Federal Reserve telling you here are the reasons why you own gold, because it's going to revalue. It's about revaluing and being able to put the debts into a smaller context versus we're just knee-jerk buying it as a reflex as a safe haven against stock market collapses or whatnot. Your thoughts on that so far?
We are seeing right now what Vince Lancy mentioned, that we are executing a new bilateral soft devaluation strategy of currencies. So yes, you will have assets moving up in value if you're looking at stocks, you're looking at groceries, you're looking at everything moving up in price. It's the devaluation of the currency. So you have to prepare for the reset that's happening. Yes, I looked at the paper yesterday from the Federal Reserve for some clients in the office yesterday. They didn't believe me. And there were 4 countries where gold was used to solve the fiscal problems, where you don't need to sell the product. You don't need to sell your silver, or gold, which is very liquid, which is the reason why central banks hold it. You can revalue the gold price higher to measure up to the debt. So you've, number one, shield away from the devaluation of the currency, so you're protecting, but you're positioning for growth. In 1985, major economies joined together in the Plaza Accord to weaken the U.S. dollar, rising metal prices to boost their balance sheets. That's all it was. And we have to do the exact same thing if we look at the currencies of Venezuela, for example. The Venezuelan bolivar, they saw the most epic stock market rally ever. 200,000% the stock market was going up. However, it was the currency that was crashing beneath. So you have to be cognizant that it's the currency that is being devalued right now.
So getting back to the article, they're saying, okay, in the past, it's gone up because of a reaction to dot-com bubbles or to this or that, COVID, etc. This kind of like rush to safe haven buying, but this time feels different, okay? They said this year, President Donald Trump's tariffs and his standoff with China have threatened trade chaos. Wars in Europe and the Middle East might have spiraled out of control, but they haven't yet. Not in the Middle East. I think they had peace accords. America has experienced its longest ever government shutdown, which is over. I don't know how that affects the price of gold exactly. Fears are mounting that an AI stock crash could bring down the real economy. So are they assuming here that people are owning gold because they expect NVIDIA to crash? Because I got to tell you, very, very few people that I know own both. And a lot of people who are very high on what's going on in the AI don't care about gold. Just from my own anecdotal experience. But it's tricky to reconcile the article, but it's tricky to reconcile these on again, off again shocks with almost linear climb of the gold price. So they're confounded, I got to tell you. They can't figure it out. This whole article is like, we have a point, but we don't have a point. We're really just confounded by it. The metal was already, and because we're confounded by it, maybe you should avoid it. The metal was already hot earlier this year when warnings of AI bubble were less audible. Mr. Trump's trade deals, President Trump's trade deals, his truce with China, peace in the Middle East, none has had the impact on its price. After America's shutdown came to an end on November 12th, stock markets rose, then slumped. But that was because the odds of the interest rate cut by the Federal Reserve fell as well. Gold's rebound accelerated. So it's not even the idea that the Federal Reserve is going to cut rates is pushing gold. Gold doesn't care about the interest rates anymore.
No, even though December 10th, I think 80% of the traders in the global markets are betting that they will cut interest rates on December the 10th. So we have to be ready for that. And we have to be ready for what the speech is. Look, pullbacks can happen in the market, likely because of speeches. That's what drives the market these days. No longer are the markets reacting to retail sales, the fundamentals of what
the separation of Main Street, Wall Street.
Separation. It's all about what the Fed is saying, what they do, and what they're planning to do. And I highly recommend check out the Federal Reserve, the gold revaluation examples. They never talk about gold. And the mere fact that they printed it and still public, gold is very relevant. And you keep your portfolio relevant with gold and silver. If you were to sell the gold and silver, for what? You're going to be in cash that's being devalued and eroding. You better have another asset class to jump into. Bubble territory? I don't think so.
Well, again, this is saying institutional investors are seeking the refuge because they fear some sort of crisis, which has never materialized. Okay? So I guess they're saying you've been misled to own gold because their own narratives, this is The Economist, their own narratives of, disaster in the Middle East, a blow up into nuclear war in the Ukraine, AI collapsing, which I think they are pro-AI,
right?
That none of these things have come to fruition. So why are you holding gold? Gosh darn it, right? So it's like you're using your own narratives against you. So let's try to keep pushing here. A second explanation contends that the gold rush is being driven by central banks seeking protection not against short-term meltdowns but longer-run changes. Okay, well, I'll go with that. According to this debasement theory, America's political dysfunction and ballooning public debt, as well as threats to the independence of the Fed. Okay, hold on. Are feeding fears of rampant inflation and killing the greenback, causing central banks worldwide to swap long duration of dollar assets for safe as houses gold. The problem with this story, the problem with this story is it lacks evidence. Okay, I thought that was their story they were pushing. The problem is it lacks evidence. Were American securities being dumped en masse, the dollar would be falling and long-term yields would be rising. In reality, the dollar has been pretty stable after slumping this year. Yields on 30-year treasuries have been mostly flat. Okay, so
the U.S. dollar.
So there
versus
again,
other
this is
major
like a reaching paragraph.
A far-reaching paragraph.
They're saying that is it central banks are buying to protect against that this de-dollarization will cause a collapse in the U.S., but that collapse isn't happening. So why are central banks buying? I hope they're not accusing central banks of being dummies. We'll have to get back to it. More to come on The Real Money Show. If you want to get physical gold and be your own central bank, the number 18778 silver, the website guildhallwealth.com. This is great. I love hearing the sort of their take on what's going on, but it's leading us nowhere except for the fact that they're saying essentially beware. Maybe you shouldn't have it because all the reasons you think you're holding it aren't coming true, even though these are the reasons we want these things to come true.
Such gaslighting, honestly.
We're just going through an article put out by The Economist. It really seems like gibberish. It's a cautionary tale saying that you've had a scorched run in the precious metal market. But, in the last segment, they said, according to debasement theory, he said, what is debasement theory? They don't explain it in the article. They said, the second explanation contends that the gold rush is being driven by central banks seeking protection not against short-term meltdowns, but longer run changes. According to this debasement theory, America's political dysfunction, ballooning public debt, and threats to the independence of the Fed are feeding fears of rampant inflation. But they go on to say that the problem with this story is that it lacks evidence. In other words, there's no evidence that there's political dysfunction, there's no evidence of ballooning debt, and there's no evidence that that there's a threat to the independence of the Fed. All three things that this magazine pushes.
It's ridiculous. It's absolutely ridiculous. We do have historical proof. All currencies that are not backed by gold and silver go to zero. They all fail. All currencies.
So you're agreeing with them?
No, not at all.
Okay.
What we're seeing is a rapid movement into precious metals. I don't know why they're omitting or overlooking the fact that you have actual major institutions and banks that are repositioning their portfolios to include gold, not to sell gold. They're positioning portfolios to protect against the devaluation and the debasement of the currencies. And that needs to be, included in this article. Analysts right now are pointing to, such as Jefferies, which is the major U.S. investment bank that was highlighted by Vince Lancy not too long ago. Their analysts point to the ballooning debt that's going to continue to rise. I think the U.S. is at now $38.2 trillion in debt. Record central bank purchases over 1,000 tons per year from Russia, China, India.
Don't you think the ballooning debt, though, is actually being offset by the fact that they're getting rid of things like spending on U.S. aid and spending on the open borders that they had to spend on, or that they're getting deals, they're getting money coming in, not just spending and ballooning the debt, but the debt continues to increase, but there's now asset side of the balance sheet and income coming in. Like if you go to the bank, they ask if you're going for a mortgage, they go, what's your debt? How much money do you earn? What kind of assets do you have? Right? Well, okay, the debt is still rising. It hasn't stopped and started going down, but the other two are increasing, no?
Absolutely. And you're also creating policies that will invite capital coming into your country to flourish and to actually safeguard against what's happening on the outside. So actually funds are moving into the U.S. at an astronomical rate, changing policies such as the 50-year mortgage. People scoff at that, but it's actually helping the saver.
Well, what I find interesting about that one is when the shoe was on the other foot, you would have had the other side yelling the praises too. Like I've seen both sides, and both sides praise it in certain circumstances. Let's quickly wrap up on this article. They do mention central banks. They say central bank has slowed, not accelerated. Well, look, if the price has doubled in a year and you have a certain budget, then you're buying half as much. So it is definitely going to look like buying has slowed down because you can't just keep buying the same capacity. Now, I think we get to the crux of it here in the last paragraph or two. This leaves speculators as the most likely driver of recent price movements. On September 23rd, at last time, America's Commodity Future Trading Commission released data owing to the shutdown. Long positions held by hedge funds on gold futures were at a record 200,000 contracts, equivalent to 619 tons of metals. Net purchasing by exchange-traded funds was also strong. Last month, ETF flows ebbed. That, together with just 100 tons worth of net sales by hedge funds, would explain much of the price dip observed late last month. Estimates, Michael High of Societe Generale Bank, ETF flows have since rebounded. There goes their theory again
right away
on the speculators. It would therefore appear that the gold price closely tracks these flighty funds' appetites. What may have started months ago as limited push for more gold in central bank reserves thus seems to have snowballed into a self-propelled mass of hot money chasing prices higher. That is a bad omen for strong hands. At some point, this classic momentum trade of investors following trends will stop. The longer it lasts, the more chips the brashest players stand to lose at the end. Got it. Okay, so it's all just been a speculative bubble, Jerry, as if the retail investor, okay, your everyday mom and pop, can really affect the price, right?
It's like we affect the weather? Absolutely not.
Like the amount of gold and silver being purchased by sovereign wealth funds is driving the market. The central banks, yes, they are underpinning the market because they're willing to buy at all-time highs. That tells you everything you need to know, okay? So now you're left with, yes, the retail investor is going to move into precious metals. Yes, there may be some hot money, right? Okay, but the hot money, this is not a frothy trade yet, right? At all.
When you see the COMEX and the LB
but why?
being
tell
drained.
Me, Jerry, tell me why it's not a frothy trade. That's what the list, because Economist is saying we've covered everything. Nothing makes sense. So the only thing that makes sense, that the reason why gold has doubled in the last year and silver's gone up, whatever it's gone up, 70% or something, is that it's just hot money chasing trades. But I don't hear people, I'll tell you this, I don't hear people selling their Bitcoin and buying gold. I don't hear people saying, I've sold my entire portfolio, I want to buy gold. I have not heard, and this to me is the telltale. So tell me about this gold. I haven't gotten that guy calling me.
Right.
Right? Because that's what they do at the top, right? I haven't seen these people who are buying the hot thing. Tell me what frothy looks like in this market. Although I just did.
When you have only 1% of our population in gold, 1% of the North American population that own any physical precious metals, that's not frothy at all. There is participation coming into the market, and that's what we have to be excited about, especially when we have major banks like Goldman Sachs allocating 20% of their clients into physical at this moment in time. This is just the beginning. Nothing is frothy at all. We have a lot of topside potential to go with the participation in this market because there's over $200 trillion frothing around in derivatives, in the repo markets, in the stock market bubbles, and very little participation in gold. And it's just ramping up right now. It
is just ramping up. And I'm gonna talk to you about something in the next segment that shows that it's not just central banks accumulating, but the financial market is also accumulating, and they're doing it in a way that's going to balance out their own balance sheets. That's going to help lift their balance sheets. Stay tuned. The number 1-877-8-SILVER, the website guildhallwealth.com. If you want to hold physical gold and silver, give us a call. We'll show you how to do it. We only deal in the best products, most liquid products, universally accepted products. We'll walk you through how to hold it for the first time and how to own it, the way our clients own it, whether you want to buy it direct, store it in a vault, or even have it in a registered account like an RSP TFSA. The number 1-877-8-SILVER, the website guildhallwealth.com. We do talk a lot about central banks, and they're not our friends, let's be honest, but they are buying a lot of gold, and we like that. But I'll tell you, Jerry, every new product I see being put out by financial institutions, new trading gold things, because you're seeing a lot of them. We hold it 1-to-1. You're going to buy grams, all of, along with your ETFs, along with your gold-backed funds. the growth in the ETFs, et cetera, all of these things add to the balance sheet of a bank's book.
True.
They want gold on their books. The fact that they're pushing these is an example that they understand. If we can have it the way the central banks have it, but we will own it. Our investors will invest in it, right? They will pay us to own the gold that we will now have on our books, which will protect us and grow our balance sheet.
They could definitely use that collateral for sure.
It's like you're surprised more jewelry store, companies don't own, like Graf does it. He's like, I am going to buy the biggest, most vivid colored diamond I can find because it's going to be on the asset side of the balance sheet on my company,
Absolutely.
which is only going to keep going up. Why wouldn't a bank want that too, right? Why wouldn't a trading company want that? And you see more of these instruments coming out. That's what I see it as. I see it as it's not
for your benefit.
Yeah, come on. It will make money. Let's not forget that. But it's not like when the bank is saying, "Well, we can sell you gold too. If you're gonna buy it, at least like take your money out of the bank and buy it with us because it's going to be gone." This is a way to keep the client, keep the assets, grow the assets, make yourself stronger, and hedge in the interim. It seems like a no-brainer. It's a great idea that they're
just
doing
like that article. I think it's a desperate play to try to keep the monies invested in these institutions. As we know, these are fractional reserve banks, and they require the assets, they require the reserves to be in the banks, so they can lever up, so they can lend, so they can borrow from. Liquidity is pretty much gone. We see the overnight repo market showing signs of what it was like just before COVID, before the COVID lockdowns, and the massive amounts of money printing that caused the 40-year high inflation that's coming about. Money, they are very desperate right now to keep the money in the bank. I'm dealing with about 4 transfers right now, Jeremy, coming in from other institutions, and they're literally bullying people from trying to move into something direct and outside of the banking system. And that's what we do.
In the meantime, this came out yesterday. Silver just logged its 5th straight annual supply deficit, 95 million ounces short per the Silver Institute. Industrial demand may have dipped 4%, but it still isn't enough to rebalance the market because investment demand is accelerating. And there's a twist. This is coming from American Coin and Currency. I'm no chart guru, but silver price action looks like a textbook cup and handle forming, one of the most reliable bullish continuation patterns in the game. That's saying short term we're getting a cup and handle versus the 50-year cup and handle. And again, after 50 years of price repression in this market, of financializing the market, people are realizing it's revaluing, and they don't necessarily know exactly where it's going. And it's hard to talk about the final price because we're in a process, not an event.
You're right.
And so, you kind of look at what the banks are saying. You look at what the analysts are saying. You look at your ratios and your criteria to understand what the value of the metal is. And if you don't understand what the value of the metal is and what it should be able to purchase you throughout history, then how are you supposed to know where the top is? And that's an ongoing thing because the debts are ongoing, right? The political structure is ongoing. Everything is still in flux. So you can't just pick a point in the future. You have to pick a point sort of, a month or two out, a year or two ahead, not 5-6 years into the future and say $27,000 gold. No, let's 15% a year for the next 5 years. You'll get to 8,000. There's a play.
Absolutely. You have to use ratios. You have to use what we have seen gold and silver do throughout history. We have a lot of conservative forecasts in precious metals. Jefferies, a major U.S. investment bank, said gold is projected to reach 6,600 per ounce within 12 to 18 months. And this was reported 2 months ago. But Vince Lancy argues that if you just value gold against the U.S. M2 money supply, if you start measuring the gold against that
money
ratio,
that's been printed,
the debt, just like it was in the 1980s, you don't stop at 6,600. You land closer to $12,000 per ounce. His math is very simple. In 1980, gold peaked at 850 when the M2 was 1.6 trillion. Today, the M2 money supply is over 21 trillion. Adjust the ratio, and gold should be in the five figures. And he calls for that remonetization phase when gold regains its role as a reserve currency. The Federal Reserve is posting it. Gold is becoming relevant. You never see the Federal Reserve talking about gold, but it's printed on their website. Go check it out.
The number 18778 silver and the website guildhallwealth.com. There are lots of reasons to continue to be in the gold and silver market, and we bring them to you every week. If you've missed an episode, I had a client in the office, Jerry. He was coming to sell some metal. He ended up selling a whole lot less than he thought he would. And he said, Jeremy, what do you think? And I said to him, why don't you listen to our show? I tell you what I think every single week. Here's the YouTube channel.
Broken record.
I'm like a broken record. If you go to YouTube, you can catch past shows on Rumble as well. You can follow us on X or even Spotify, iTunes. You can catch the show anywhere. Of course, you can catch it here on Saturdays at 1:30, Sundays at 10 a.m. And we'll tell you what we think. And we do think it's moving much higher. We're going to continue to bring you the numbers and the facts and the reasons why we believe it's going much, much higher from here. Nothing goes up in a straight line. The number 18778 silver, the website guildhallwealth.com. Thank you, Jerry. Thank you to all our listeners for joining us this week. We can't wait to speak to you next week here on The Real Money Show on 640 Toronto.